Welcome back to lesson number 8. So today's lesson is about order blocks and two new concepts that I'll be introducing called turtle soup and IOFED. IOFED, well, you guys will see what it stands for later. But with these topics today, it's not so much about, being able to spot order blocks and essentially identify them on the charts. Morgan's already made a lesson for that purpose, and you guys can search through, find that specific lesson if you need to, and watch it. Rather, the purpose of today's lesson is on higher probability trades, picking points of interest, such as order blocks, that have a higher probability of playing out in the direction that you want them to. So let's get into it. So an order block, the first misconception, right? Of course, I know it's a candle, and that's, essentially why it's called a block. But that order block, that candle, is actually a range of price, right? You can agree with me, from high to low, it's a range of price. This range of price is considered liquid. It has liquidity present in there. In this order block, right? This order block is a tool for bigger players in the market, institutions, to be able to fill their orders, right? And that theory, of course, is theory, we can't necessarily prove all of this unless we speak to people inside the institutions, but that theory has logic behind it. And it also means that we should only be using specific order blocks when we're trading. And you'll see what I mean in a second. So if you guys think back to the breaker block lesson, I said that breaker blocks can only be present when there is a market structure shift. Order blocks can be present when there's a market structure shift or when there's a breaker structure. And all this line means, the third line, is breaker structure or market structure shift and return to order block. It's a trading strategy, RTO. A bearish order block is an up close candle before a bearish move, and a bullish order block is a down close candle before a bullish move. So over here I've got one example, right? So if you guys follow my cursor, you can see these two candles, these two green candles. These are the order block, they are the order block that I want you guys to focus on, right? And you can see I've drawn in the short here using that tool from TradingView, just to help you visualize how we could have actually traded this. So as I explained to you guys, right, breaker structure or market structure shift, and then we return to order block. This order block, in a way, we can say, was validated when we broke the structure here, right? And what is this? This is a bearish order block, right? Up close candle before the bearish move. Up close green candle before a bearish move, right? So it fits our description, and of course this is a continuation trade. It's not necessarily a reversal. So if we talk about higher probability, you guys might remember, this diagram, I used it for my mitigation blocks, and of course I'm applying something similar here. What I'm trying to show you guys, right, in this specific diagram is premium and discount. So if we're shorting, now I've taught you guys breaker blocks, mitigation blocks, and order blocks and imbalances. So wherever we're shorting, right, it should always be in a premium. And sometimes your order block, your breaker block may not be in a premium. Me personally, if that's the case, I'm not taking the trade. It needs to be in a premium. And that's, it's just part of my model, my strategy, and your risk to reward. It just makes a lot of sense to keep it in your premium when you're shorting, and of course in your discount when you're buying. So I say this word quite a bit, and I know some people may still struggle to grasp what it means, displacement, right? And the second line, IPA, you probably see a lot of people mention this. A lot of you listening probably will know what it is. Inefficient price action. It's an order block followed by a fair value gap. A fair value gap is an imbalance. So if we look at this, right, the reason I've picked this example, right, this is a very textbook trade. This is something I would have taken. I did not take this. This is on Bitcoin, by the way, on the Bitcoin 30-minute chart, quite recent to when I'm going to drop this, so you guys can go see it for yourself. And the reason this trade is so nice, right, we have this order block created, this last push up, and then we have a very strong imbalance, right? Price just drops. And then, right, what does price do? Bit of sideways movement. What does sideways movement do? What do we call it? We call it accumulation, right? And as I've taught you guys, accumulation, there's a meaning behind the word. What are we accumulating? Orders. We're engineering liquidity. That's what engineering liquidity is, accumulating orders. So what are we doing? We create a trend line from here, running across. So now, does that support the idea of taking this order block? Yeah, yes it does. Because now we have, two big reasons, or well, three to start with, kind of like a checklist before we take trades. And the way the checklist works, right, is, of course, like I said to you guys, we have our premium and our discount, ticked off. It's in the premium, we're shorting. Then, of course, we have our order block. Is it followed by displacement? Yeah, we've created a, very, very strong move here. And three, this is what turtle soup is. Are we engineering liquidity before we approach, the array? And yeah, we are. Because we created a very nice trend line from here, right? And of course, price moved up into the order block. As you guys can see, it's been marked out from the wick. And we had a very, very strong move down. So this last point I made, turtle soup scenario. Turtle soup, right, is when we engineer liquidity. Liquidity comes in, liquidity rests above old highs and lows or below, and it comes in the form of, again, like I just said, highs and lows, or in the form of trend lines, right? So we had a trend line, as I explained to you guys, running this way. We also created this high, so of course we swept into the imbalance and we created this high. This is liquidity resting here that was waiting to be taken, and then we headed into the order block. I want you guys to kind of like map out, right? Just, of course, you can see it and you can see what price done. We created an order block. We have displacement, this very strong move away. Then, of course, you create this trend line. We have quite a bit of sideways movement. We have, regular sweeps. And we're taking the sell side out. Sell side is, resting below price. And then we have this move up, right? We have a market structure shift because we're headed up now. And we create this high. This is, a point where we know liquidity is resting. And we tapped into this imbalance. After we created this high, right, we didn't have a market structure shift and price is bullish. So we know price, is going to head higher. So we've now created liquidity here, right? We've created a retail support of some sort. You can say this is like mini trend line, or you can just call it a support. I'd call it a support. Then we head into our order block. We tap into it. We have displacement away, very strong move. And by taking out this low, we create a market structure shift. So there's been a trend reversal now. So turtle soup is not anything that's very complicated. All it means is liquidity engineered below or above an array. In a lot of setups, of course, I probably should have marked it on this, right? And I might resend this picture in the bootcamp channel with the actual liquidity marked out, just so it's easier for you guys to visualize. It's a very textbook example, right? And that's all turtle soup is. It's making your trades and setups higher probability. So now let's discuss why, right? I was speaking to one of the students in the group chat about this. The job of the algorithm has two jobs, right? To rebalance areas of imbalance in the market and hunt liquidity, right? If the imbalance, yeah, is meant to rebalance areas of imbalance. Do you think it's going to create these imbalances on purpose? No. These imbalances are usually a sign of intervention, that someone has stepped in and, manually injected liquidity into the market, and therefore we've created this imbalance that will then need to be rebalanced, right? So now, why does this make our trade higher probability? Well, first of all, we know price hunts liquidity. So if we're engineering liquidity via this trend line, blah, 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 then we know price is likely to take it, especially when it's this clean. This is a very clean trend line, that formed here. And now, why do we use this order block? Because this order block was created and then we had a very strong push down. Now, I want you guys to think back to the start of this lesson. What did I say? That order blocks are ranges of price for who to fill their orders? Big institutions. And who can probably create an imbalance with a lot of their money? Big institutions. So what does this show you? There's some sort of, let's say, manipulation in play. That this is being created. This is not by chance, right? This order block was created and it serves a purpose because price returns to it. Orders get filled. This imbalance gets filled. All of this liquidity gets taken and price moves away. In a way, the way I like to see it, this is a very efficient move for price, right? I explained to you guys there's two jobs for price, or two roles: rebalancing and hunting liquidity. We take the liquidity, we rebalance, and we also tap into the order block and have a move away. But yeah, so all these things I'm saying to you guys, right? You can now take this liquidity, take these imbalances and apply them to your other arrays, apply it to your breaker blocks, for example. I taught you guys, I didn't teach you the model yet, I will, but I wrote down a model: market structure shift, breaker block, and OTE and FVG. That's what I told you guys. Now, apply the same logic that I just taught you guys to what I said in that video. Makes sense, right? Why we'd want to take a breaker block that has an imbalance lined up with it rather than a breaker block that doesn't. It's just higher probability. Makes more sense. Okay, cool. The last thing I like to touch on, so I explained to you guys, right, what total soup is. It's when we have liquidity engineered, we sweep that liquidity into an array. That's what total soup is. You can have your liquidity engineered, for example, below an order block, below a breaker block, but when your liquidity is engineered below an imbalance, a fair value gap, we call it IOFED, which is Institutional Order Flow Entry Draw. That's what it stands for. So now, again, let's think about this quite logically, right? Institutions know how this algorithm functions. We know the algorithm doesn't draw to order blocks. It doesn't, treat order blocks as magnets. It only treats two things as magnets, right? Imbalances and liquidity. So, is this not two birds, one stone? If we have equal highs, right? First of all, why is this liquidity? Because by retail traders, normal traders, this will be considered a resistance level, right? They'll think, this is a resistance. And above this, what do we have? An imbalance. So what does the algorithm want to do, right? It wants to sweep liquidity, and of course, we'd be rebalancing this area by sweeping this liquidity, by taking out these equal highs. The more equal the highs or the lows, the more likely they are to get run. And these were pretty perfect. So, it was coming. And this chart is actually the SP500. This was called in one of my weekly outlooks a few weeks ago. And there's a few more things you guys can notice, right? Of course, this is on PowerPoint. I can't draw a fib. But let's say the 0.5 is around here. So what's here? This is all premium, right? And what do we want to do if we have IOFED in this scenario? We want to short. So we'd be shorting in a premium. We'd be sweeping liquidity, prices filling an imbalance. Does it make a lot of sense to short here? Yes, it does. I did not take this trade. I'm not trying to capture you guys, but this would have been a very, very clean setup and a very obvious one in hindsight, because of course we did call this in a weekly outlook. And IOFED, I know it's a big kind of phrase or name, don't let it scare you. It's very simple. Sweep of liquidity into a fair value gap. As you guys can see, equal highs got swept into this FVG. This is a model I love trading, and that's because it's so simple. If it's in premium or discount, especially on your lower time frame, it happens very often. And the next time it does, I will point it out for you guys. That's about it from me today. I know the video wasn't massively in detail, but hopefully some of the theory that I touched on today, not only does it like teach you something, but with the previous lessons, I haven't given a lot of theory. So I hope it kind of helps to bring things together, helps you guys to see, why I'm telling you to do certain things, why we're trading certain things a certain way. But as usual, any questions, just message me and I'm going to be happy to help. I'll see you guys in the next lesson that's going to drop at some point this week as well.